this is a point of permanent distortion. Silver was and actually remains our number one pick for the year. Still bullish on silver. I still see it getting back to 120 or higher by the end of the year. It's not a far stretch from where it is. Copper would be above 7 actually by the end of this year, dollars per pound.
How can you explain, from the perspective of permanent distortions, why markets are still grinding higher? In fact, to new all-time highs.
The fact is that
with the onset of the Iran war, one thing has been certain. Supply chain bottlenecks create opportunities for investors as well as distortions to the economy. Our next guest is an expert on distortions. She's written literally books about this, and we'll be discussing her take on which commodities may actually survive this Iran war and perhaps even prosper, and which permanent distortions are now caused in the supply chain globally that investors and consumers alike need to be aware of. She's Dr. Nomi Prins, founder and CEO of Prinsize Global. And it's just good to have you back, Nomi. Welcome back.
Thanks so much, David. It's such a pleasure to be back with you.
Let's start by talking about hard commodities, gold versus everything else. It seems that the safe haven trade, which is something that people have been looking to during times of distress, have disappointed investors, while things like copper have soared to new all-time highs. And in fact, if I were to show a chart shortly after this question, you can see on the screen that copper and gold, which have traditionally moved together, have now diverged. Now, is this a case of just gold consolidating, or do you think capital is shifting away into things that are, I guess, impacted the most by supply chain bottlenecks caused by the Iran war, which presents an opportunity for some investors? What do you think is happening?
Yeah, so we're definitely seeing gold in a range right now, having reached a peak before the Iran war and a historical high, having come off of those highs and now basically trading in a range. On the other side of that, though, we've had reconfirmation of gold relative to U.S. Treasuries that it is now the number one reserve asset of central banks. It was at the end of 2025. The ECB, European Central Bank, just confirmed that. And it does have that staying power. But what's happened is, from an investor perspective, the part of the story, not the full story, just the part of the story around gold, as you mentioned, with respect to a safe haven for the investors sort of on the margins of gold investment, that has dimmed down, where the focus has moved more towards oil spikes, oil and LNG and natural gas. So that's what happened just from a standpoint of new money coming in. It doesn't mean that central banks aren't currently continuing to buy gold, continuing to use it to diversify against U.S. debt, against the dollar, and to solidify their monetary policies as collective entities in the global economy and with respect to global trades and settlements of trades. So we're seeing a bit of a drawback on that, but that is very temporary because the main strategic players in gold remain involved in the metal, and it's really just the margin that has changed. And I think this is a great buying opportunity for gold. It's a great opportunity to be patient if you're already in it, and it's a very good opportunity to be selective on which miners have good plays in neutral jurisdictions, which brings me to the other part of your question, David, with respect to other commodities. And copper is one. Actually, in the beginning of the year, when we listed our top 10 focused commodities for the year, copper was number 3, and that gold was after copper. I think we put gold in as number 5. No disrespect to gold, but because we see copper as having such a multiple set of components that drive its price. One of those were tariffs and these sort of export control wars that are going on between copper producers throughout the world and copper refiners. For example, in China, there has been an imbalance. And what we saw in the wake of the Supreme Court judgment against some of the tariffs that the Trump administration put in general on imports into the United States is that there has been an investigation launched at the time into copper under Section 232 of the 1960 statute on trade with as respect to national security matters. And that report that the administration asked for from the Secretary of Commerce is due out on June 30th. What that will probably show, and this is one reason for the squeeze up, and I think continued squeeze up in opportunity in copper and in copper miners in good jurisdictions, is that it absolutely remains a strategic, critical asset and necessity for the United States for electrical purposes, for rewiring purposes, for construction infrastructure purposes, but also because it's in short supply from a production standpoint. So 232 will probably show, when this report comes out on June 30th that copper can be classified as a material important metal with respect to national security, which will allow tariffs on processed copper to increase starting in 2027 and 2028. So we're seeing positioning into that potential result right now. That's one thing that's happening. The other thing is that copper in general, the smeltering of copper, the processing of copper is expensive. It's predominantly done in China, and then we get processed copper back. And so that's one of the reasons for this particular report. And it continues to be an industrial necessity for basically continuing to develop infrastructure throughout the world for energy and defense and just general population demand purposes. So we are going to continue to see these new records, and we had suggested that copper would be above $7 actually by the end of this year, dollars per pound. We think that's going to continue. Already seeing breaks above that, and also it's important about the ore grades. We've seen a lot of outages in Peru and Chile and so forth, and it takes so long for a new mine to come into play that the permit process, the jurisdiction process, the safety process, the community connection is all very important for copper. And I think that's another reason we're going to see really good opportunities, and we are in mining companies that are further along the junior mining process and in copper prices itself.
Before we continue with the video, I like to address one of the fundamental problems of owning gold. Now, gold is seen in most cases as a store of value, but it has one major problem. It doesn't generate a yield in itself. And that's where today's sponsor, Monetary Metals, comes in. Monetary Metals introduces a model where gold can produce a yield paid in physical gold. Through their leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces. That means your returns are measured in gold itself, not just in fiat currency terms. In an environment where many assets depend on price appreciation alone, this approach allows gold to serve both as a store of value and as a source of income. The metal remains your asset and can be redeemed at any time. Thousands of investors are already earning a yield on their gold through Monetary Metals, so visit their website today to get started and learn more. That's monetary-metals.com/Lynn. Link in the description down below, or scan the QR code here and get your gold to start working for you now.
On that, Trump has made changes to steel, aluminum, and copper tariffs like you alluded to. He expanded the existing category of industrial equipment that is subject to a 15% tariff to include mobile industrial equipment like bulldozers and forklifts. So he's bringing tariffs down from 25% to 15%. Does this change your thesis at all for investing in these metals, or is 25 to 15% not significant a difference?
It's significant if you look at the supply chain of these important industrial metals, and the fact that we're also sort of rating the U.S. its defense instruments with respect to the Iran war, and that's put a sort of higher squeeze or higher bid on processed steel, processed aluminum. If we look at aluminum and steel, but aluminum in particular as one of those industrial metals in short supply because of the production that's mostly done again in China, and the fact that we have about 4 smelters in the United States that can process, but only one is operating capacity for various reasons of being old, of not having been updated, of not having the right sort of grade of aluminum coming into them. So it is additionally something that is in short supply as more building gets done. So it's not as much the 15 to 25% tariff. What these labels do, what 232 reports do in terms of changing where tariffs are, is they create just a new level by which we can consider the entire supply chain. And that's something that's important to note here. It's not just you're getting raw steel or raw aluminum. You're basically incorporating expenses throughout a supply chain where production is mostly done outside of the U.S. And this administration, to an extent, the Biden administration, the Trump administration before, and has tried to move the needle on reinvigorating some of that processing and production for industrial metals, for copper, for silver, for uranium enrichment. And all of these things are still years away from our needs of full capacity of the end products. And so it doesn't really it doesn't really change our thesis for these metals. And in fact, when we put aluminum on our top 10 list as well in the beginning of the year, it was mostly because of the processing chain and what we've seen since the Iran war, because there are some processors out in the Middle East, and the processed aluminum hasn't been able to get through the Strait, which is operating at 6% of its pre-war capacity right now, and that has squeezed up prices in that metal as well. And so these are about full supply chains and full geopolitical relationships and where stuff is made and what can be restricted and by whom. And that we continue to look at. Tariffs are a component, reports are a component, but right now the need for metals and processed metals exceeds the ability to put new product from a raw ore perspective, a raw feedstock perspective into the market.
I want to tie this back to your hit book, Permanent Distortion, and the concept of intervention, government intervention during crises, which is something you've discussed a lot in your book. Now, this is a situation that, just based on observation, we can say the Iran war has caused an immediate sell-off in the S&P and stocks, but they've rebounded very shortly after. There was a V-shaped recovery, and now we're back at all-time highs with a lot of stocks, and the AI narrative has driven things higher. On the other hand, the deficit has widened in the U.S., defense spending is projected to grow, and inflation expectations are now higher and more sticky. And so my question is, first of all, how can you explain, from the perspective of permanent distortions, why markets are still grinding higher, in fact, to new all-time highs, even though the Iran war has caused arguably permanent supply chain disruptions around the world?
Yeah, that's an excellent question, David. And the fact is that even if we look at our Fed and the size of their book, it is not as big as it was in terms of the treasuries it's bought during the COVID period, but it's still $2 trillion more than it was at the height of the financial crisis intervention. So they're basically running a $6.5 trillion book. We've got a $39 trillion amount of debt outstanding, which is only going to increase. So if you even look at, let's round that up to 40 by the end of the year, you're looking at a significant percentage of holding still of public debt on the books of the Fed. It has not basically stayed with quantitative tightening beyond that $6.5-ish trillion level. In fact, in December, the New York Fed has started to buy it's not a lot, but $40 billion worth per month of treasuries back. I believe that's what's going to happen when Kevin Warsh comes in. And I think this is part of the market positioning that has been evolving in the wake of the Iran war, even with the higher spikes we've seen in oil driving higher inflation costs, is that we're going to see more bond buying from central banks, whether it's called QE, whether it's less runoffs, whether it's we're going to go buy part of the curve from the standpoint of Treasury, buying back some of its treasuries or doing some sort of joint initiative with the Fed, which has been floated by this administration. I think we're going to see that. And I think the market is anticipating some of that long end drag that we have seen now because of inflation being picked up again by this potential intervention on the long end of the curve. That's not to say we're going to see rate cuts by this Fed under Kevin Warsh at the offset because of what's going on. We won't, but I believe we'll see more activity in the long end. We carry too much of a burden of servicing the payments and the interest payments of our Treasury debt above $1 trillion. It's a year to not have conversations going on now between the Fed and Treasury Department, as they have been doing before Kevin Warsh's appointment. And I think that is part of the reason why stocks like AI, which are effectively long-term buys, even with some short-term funding involved, are continuing to see bids. And then again, tying that back to commodities, what has lagged the AI sort of reboost after the initial sell-offs during the start of the war is that you cannot run AI data centers. You cannot run the construction of the infrastructure to get to them, the wires that basically supply them with energy and everything in between without without the commodities that are necessary to supply all of that power. And that ties you back to a lot of mining capacity that needs to be examined from the standpoint of long-term investment and opportunity in that part of the market, because you cannot have this appreciation without. So we see the financial distortion driving these investments in AI and other large companies. And then we see a little bit of a lag with some of the mining companies and some of the commodities, but less so, that I think will catch up in the long-term investment cycle.
One theme of your work is that crises have reshaped often the financial system. And I wonder if this conflict in Iran could be used as justification for enacting some of the policies that were shelved before. I'm talking about greater central bank intervention, more strategic subsidies, larger deficits, more spending, so on and so forth.
Yeah, I mean, as you said before, we're definitely seeing a larger deficit. There have been numbers floated to increase the defense budget in between times. That probably won't happen, but when the next the next budget is determined, and the defense component is always the component that drives the budget anyway, and it creates all the side deals that happen in Congress. It's like, we all agree this is defense. Let's figure out how everything happens. But to your other point about other dislocations there and distortions, I do think there is going to be obviously more debt, obviously higher deficit, obviously higher debt payments. But I do think we're going to see some more strategic intervention from the standpoint of a Treasury Fed type of initiative, or more Fed quantitative easing or so forth, to take some of that pressure off of not just Treasury yields from the standpoint of the interest they require, but also from the standpoint of the percentage of debt that is owned by external to the United States central banks and countries. Because as a percentage, that percentage has fallen as the amount has increased by more so. So there's an accelerated drop off in other nations taking our debt, which makes sense because of the fact that it is. It is being replaced by gold and other types of commodities in central banks, and then in their supply chains. So I think we see that. And again, these were initiatives that were floated by the Treasury Department 100% by the Federal Reserve under the former chair, under Powell, that basically didn't go anywhere. But I think we'll see more conversation about forms of taking down our debt or collaborations in the coming months. I think I would be surprised if we don't see language to that effect out of the next FOMC meeting, and if not that one, then the next one.
It's been a consistent pattern that following a crisis, the central bank, or at least the Treasury, will both intervene. Now, COVID was an example. The financial crisis is an example. This is an example. Is it safe to assume that we're living in a regime where a crisis would most likely be followed by a rally in asset prices, following a bit of a correction, but intervention usually has, according to history, pushed asset prices higher? In other words, I'm not saying I look forward to a crisis. I certainly don't. But if I were an investor looking at this from the angle of, is this a buying opportunity? I would say yes almost every time. How would you respond?
Absolutely. And a lot of our research is based on the realities of supply deficits for real assets and where they go in the economy and what they drive and how scarce they actually are, on the one side of that in terms of real assets, and on the other side from a financial perspective. I think that's why we've seen these resiliences that we are seeing in the markets, because the expectation based on recent substantiation is that there will be more debt, and somehow there will be a way to take down that debt from a public perspective, on the Fed's book, from a Treasury perspective book, and it will sort of get reabsorbed into the system. COVID was an extreme example of that. And there was an extreme example of blowing up ballooning the Fed's book from under $4 trillion or $4.1 trillion to almost $9 trillion. So it was an enormously quick intervention, as happened around the world, the ECB, the Bank of England, Bank of Japan, and so forth. This is a little more nuanced, because we already have had such an extreme rally since that time. And now we have the Iran war. There's a trade-off. There's all this conversation about oil prices and inflation. So the period of sort of rebound has already happened, which is very interesting, because it does point to the fact that if there is then an intervention from the standpoint of the Fed or Treasury or those around the world, the equivalents around the world, that we could see much higher prices. And again, also much higher prices in the assets, so the selective assets and companies that are integral to to those upswings.
So if we were to identify where central banks and governments are going to be directing money next and then positioning accordingly, where would you go?
Well, I think we're seeing, for example, in Japan, we're seeing that they've had a mess of a situation in terms of the amount of debt that the country owns from a public standpoint versus what they issue. Japan is very involved in rare earths. They're looking at they just created a collaboration with the United States on that to break the stranglehold of China on rare earth metals and materials, which is enormous, which is very integral to the defense across the world. So I think we'll see, this combination of trying, for example, to defend the yen, but also to reinvigorate or buy more JGBs from the standpoint of that. I think we're going to see more treasury buying at the long end from the standpoint of a public perspective. And where that money goes, it's already being redirected into more infrastructure types of projects that relate to defense and energy. So, for example, if you look at something like uranium enrichment processes or rare earth separation processes, the United States is opening more of its public funds into financing that part of the supply chain in the United States, in Canada, in South America, and basically in this hemisphere to offset what has what's going on in China. So there is public funds that are coming in from the standpoint of directing towards the processing part of the supply chain, as well as securing the raw commodities, but very much so down the chain.
Do you think that the gap between Wall Street and Main Street is now getting wider, given that asset prices going up benefits Wall Street, but at the same time creates higher deficits, higher inflation expectations, which the normal person would not benefit from?
Yeah, and this is the point of permanent distortion. And I chose the term permanent during COVID when I wrote the book, but it really is this permanent dislocation of the wealth accumulation ability of the regular person versus these systems that are in place versus the Wall Street banks, the big management companies, the private wealth companies, and so forth that have the ability to move more quickly and in greater scale in and out of the areas of the market that are going to appreciate. And so what I do is look at and what you do actually is try to talk about opportunities for the average person also in the wake of that, because you can't control the process as an average person, but you can figure out where capital flow is going and be at least a part of it. But at the same time, yes, that gap between people versus sort of institutional wealth continues to increase as these distortions from the standpoint of whether it's debt bought by central banks, whether it's leverage debt in terms of M&A, and different types of things continue to drive this distortion between individual wealth and institutional and sovereign wealth.
The distortions caused by the Iran war, have these distortions shifted some of their preferences earlier on the year? For example, I believe talking to you in January, you were pretty bullish on silver. You had liked silver at the time.
Yeah.
I think silver has fallen out of favor with you right now. Is that correct? I'm just using that as one example.
It's interesting because silver was and actually remains our number one pick for the year. Before it hit 120 dollars per ounce before the war, when it hit its high, we had suggested it would get to that point, which it did from where it was going into the year. And then, of course, it's fallen back and it stayed in this sort of $75, $80 per ounce range. I think that is a tremendous opportunity. So I'm not off silver. In fact, we are writing a lot on pure play silver. And when I say pure play silver, 80% of silver that is processed is mostly a byproduct of processing other things like copper, like lead, like zinc. And that means there's a cost to doing that. And then the offset or the extra that goes to silver is how we see our silver. But there are a few pure play silver mines throughout the world in good jurisdictions. And those are the ones that we really highlight that feed into this ongoing structural deficit, 4 years running of silver relative to industrial uses, relative to what the Iran war has basically shown us, that the industrial uses of silver, of grids, of solar, and so forth, actually point towards more demand of silver. It's just that there's this we need to handle the oil situation right now because it's front and center. What does that mean? But what it will mean is that there'll be more attention, and there already is. That's why China's stockpiling now silver, and it's basically at its sort of highest accumulation level of silver in 8 years, because the process of finding energy alternatives to just from standpoint geopolitics and economics has even been more highlighted by the Iran war. So the fact that silver is traded off so much is painful to people in some of the mining stocks, although some of them have outperformed the level of silver itself tremendously, including we have a couple in our portfolio that have done that. And then some just need time. And those are the ones that I consider to be the opportunities. But I'm absolutely still bullish on silver. I still see it getting back to 120 or higher by the end of the year. It's not a far stretch from where it is. It's not a far stretch from what was going into January when we first talked. I think what's also happened is the paper silver trade, the ETF silver trade, the sort of easy, I'll call it Western silver trade, because it's a sort of a faster moving set of hands on silver, have depressed prices and haven't come back into the market relative to physical silver. But we've seen physical silver trade at like 180 an ounce for getting real silver out in certain parts of Asia in terms of getting it out of vault. So there's the whole entire silver market is very bifurcated right now. I think that's an opportunity. I'm a little surprised that we're still in this range for as long as we have been since the war started, and that opportunity isn't recognized. But again, it's very bifurcated. I've seen it recognized in certain silver mining names and not in others. So it's very selective right now. And the selectivity and the opportunity is where it's pure play, where you're not paying the extra energy cost of deciphering, or detaching silver from lead and zinc. You're just going straight silver. And in jurisdictions where the energy costs are low, like for example, Morocco, where you have alternative forms that don't necessarily rely on natural gas or oil, which keeps costs down. And there's tremendous opportunity. We're talking about mines with like costs of $21 an ounce, and silver is still 3 times that right now. And you don't have that kind of a margin in an AI company that you have in there. So I think it's one to really watch.
What the Iran war has taught us, not so much just with oil, but it's that broadly speaking, at any given point, a supply chain could be disrupted by a choke point being cut off for whatever reason at anywhere in the world. That significantly disrupts commerce within that area. In fact, not even if not globally, and it impacts the nations around that area's ability to consume certain raw materials without disruption. So, if you were to speculate as to which raw materials or critical materials would likely be stockpiled around the world following this revelation, what would you bet on?
Yeah, again, I got to go back to silver because I'm seeing what China and India are doing. So that's definitely one. I think uranium is actually undervalued at 85, 86 right now. So I think that's one that hasn't quite gotten itself through the system yet in terms of how severe the geopolitical control of enriched uranium is, which is surprising if you consider that it's basically the sticking point for negotiations or any kind of resolution on the Iran war between Iran and the United States is basically about enriched uranium. The White House talks about in terms of nuclear bombs. It's not that. It's basically the idea of processing or having the processing capability of uranium. The United States has basically passed acts to reduce the reliance, for example, on Russian and on Russian uranium, enriched uranium. But it's also renegotiated with Russia to lift its sanctions on oil to keep oil prices down. So there's a lot of stuff in play here from the standpoint of processing, production, where it is, and it takes a long time to bring these mines to market. So I think that's really an opportunity as well that the market's really not paying attention to is new uranium projects or at least permitted ones, a little bit down the chain, as well as processing capabilities outside of Russia and Kazakhstan.
Around the world, especially in Asia, the cost of living is going up directly because of oil. I think less so in the West, because most of our oil is not exported from the Gulf regions. But you're seeing rice, for example, go up a lot, and that's one commodity that's being consumed by billions of people around the world. I wonder how policies will adapt to this new reality. And I'm talking about this because Iran has just suspended negotiations with the U.S. They're talking about permanently closing the Strait of Hormuz. Let's see if they follow through with that. I think this theme of our conversation is the word permanent. So what would happen if, let's say, the Strait of Hormuz stays closed? And what policies would you expect, particularly Eastern policymakers, to enact?
Yeah, I mean, I think we have seen, when it's closed, we have seen certain partnership tankers get through. Again, very, very limited. We're still very low percentages relative to before the war, and you start to get more selective about routes around. Around the Cape of Hope, around different parts of the Middle East, or potentially even through resourcing or sourcing more supply from South America into Asia through sort of lower route on the globe. So we're already seeing kind of a redistribution out of necessity. I mean, out of just logistical necessity of moving some product. Now the problem is, and why prices are high. Well, there's two problems. One is that you're still paying a lot more money to move anything around the world. Whether it's by plane or by tanker or by truck, because of the fact that fuel prices are high, and they are high because of what is going on and the uncertainty that's going on and the fact that the strait is closed. So you have the whole extra cost thing that goes directly into consumers and into players down the supply chain. And then you have the redistribution, sort of the rerouting costs. Talk about choke points. Okay, how do you get out of a choke point? You have the rerouting. Okay, well, that's going to take longer, which is going to take more fuel, and that fuel is more costly. So you're adding that incremental cost up every point on that chain. And then you have to figure out how to get more tankers out. That backlog has been pretty significant to get tankers that the West is comfortable with in terms of their how they're comprised, whether it's right refrigeration for food or whatever it might be. So there's just all these points down the supply chain I think are going to change. Well, they are changing to adapt. It's odd because some of them have changed to adapt, not because of the strait, but there was a lot of adaptation going on when the tariffs were so high. When they came out so high last year, countries started sort of finding new ways to trade with each other and move product around the world and bypass exporting, or having the U.S. import that products, exporting into the United States, and we saw a lot of shifts in some of those. We're seeing that now. It's just that if there's a permanent backlog, and there's a permanent disruption and a permanent need to redistribute in a different way, the costs of just creating those new routes, given high energy prices on top of that, are high. And I think you could see those costs being bared, and as the market shifts around them, regardless of whether the Strait of Hormuz is open tomorrow or opened in parts in 3 months, 6 months, or so forth down the line. There's still these added expenses because of the risk that it might close, or the fact that it is closed, or the necessity to basically expense other routes.
Okay. Speaking of policy shifting and routes changing, this is a piece that you wrote on Prinsights. Houston, we have a tungsten problem, up 900% in 12 months on Chinese export controls, U.S. defense law, and the July 13th White House deadline. This is a good example of what happens when we have a confluence of policy changes as well as supply chain disruptions. Tell us what happened to tungsten.
Yeah, so I mean, tungsten is a situation where it's a heavy metal. It's basically the heaviest metal, which means it also is sort of one of the strongest on the table of elements. And it's had a real squeeze. It's a bit off the 900%, but basically China decided to really control or basically stop the movement of processed tungsten. Again, it's about processing, not even necessarily the raw material. The United States Department of Defense is trying to push more stockpiling. At the same time, there's less distribution. And there is a July 13th White House deadline. It's in about a month or so around the corner, to look at somehow breaking or sourcing tungsten from places outside of China, not just the physical raw material, but also any of the products down the supply chain, whether that's rounds of munition that use it, drones, chips, etc., and potentially ban some of those. But that doesn't necessarily, first of all, that will squeeze prices up higher. And second, just because you ban something, which we saw in tariffs last year, doesn't mean all of a sudden you can process it. And so there's a strong possibility that China even ups some of its export controls because this is an important metal. And that's one of the reasons we're seeing that squeeze. Now there are a couple of companies outside of that grip that we're looking at that are sort of not household names that we're evaluating to see how they will fit between now and that July 13th deadline. But that's the problem that these metals that even people in Congress don't even talk about until there's a crisis. That this is a substantial squeeze. This is like a bigger than like past silver squeezes or past uranium squeezes. It's just that your average congressperson isn't walking around figuring out, about that one metal that goes into munition rounds. Like they don't, until it's a problem.
Okay. Turning now to the Fed. So about a month ago, there was no chance of a Fed cut before the end of the year. Now, not only has that not changed, we've added, the CME Fed Watch tool has added a significant probability to a hike before the end of the year. So we're looking at July, no chance of any change. And then the probability of a 25 basis point hike starts to get higher and higher as we move out into the year, all the way up to 30% by October and 38%, basically a coin toss, whether or not we're going to get a hike or no change by the end of the year. Now, this is a regime where we all expected the next Fed chair to be a little more dovish. Trump has been adamant about firing Jerome Powell to replace him with somebody who's going to cut rates, and now the markets are going to think that the next Fed chair, Warsh, is going to do the exact opposite. Do you agree with markets?
Yeah, I don't think anything happens at the first meeting, but I think that's really market expectations as well. I think if we look at Kevin Warsh's past behavior when he was just on the board of governors, that he only one time really rejected a quantitative easing type of approach. So that's part of the reason for looking at what can be done at the long end of the curve or what can potentially be done there. Because I don't think we're going to see a rate cut. Obviously, I think we'll stay. In terms of a rate hike, I think Warsh is going to be put in this position where he has to start using like Powell terms such as data dependent, because there has been a shift up in inflation because of the war, and right now there is no resolution. That could change, but even if it does, you're going to have a month or two. Even if it changes tomorrow, you're still going to have at least a month or two of filtering through over 3% inflation. The Fed likes it below 2%. I personally think that's a hard number to get to, but that's what's in their purview right now. So if you continue to stay above 3%, above 3.5%, because this gets prolonged because of oil prices and the closure there, we could see a hike towards the end of the year. So I do believe that. On the other hand, I still also think we're going to see some movement in the long end of the curve, which could offset the hike, because honestly, a 25 basis point hike really changes nothing. I mean, if anything, it's just a statement that, hey, we want to try to pretend that we can still control something, which is basically what was happening with the last FOMC. I think prices changed for other reasons, not because rates were hiked, but a 25 basis point hike doesn't really actually matter as much as doing something with the long end of the curve anyway, in the scheme of things. And the markets don't seem to think it matters either.
This is important because we have to be aware of what happened in the last cycle. So everyone expected the Fed to start doing something when inflation hit 9.1%, I think sometime in 2021. And they didn't until later in 2022. Look what happened with the S&P 500. I think they kind of front ran the Fed hike. And then 2022 was just a bad year for all assets. You remember. I'm bringing this up because I want to know if this is going to happen again by the end of the year. Markets right now are not pricing in a 2022 scenario, otherwise it would have fallen already. But based on everything we've discussed so far, it seems to me that either we get some sort of rate hike, or like you said, the long end of the curve starts going up. Both will be bad for risk assets.
They'll be bad for risk assets, but they'll be good for commodities, because the idea of inflation as a dampener to commodities right now is kind of just a convenient narrative to explain why some of these paper versus supply trades are where they are, for example, in silver. But the reality is we are still significantly below those types of inflation numbers, the 9%, the even 7% when the Fed started hiking. And even with 10 years, say around 5%. We've been there, we've had that. And as you pointed out, we during that time, we've also seen significant market rallies. So I don't think that, I think the market is ahead of this. And I think that even though we'll have periods of volatility, we'll have, the general pouting that happens when an inflation headlight comes up that day, that Friday, particularly when it happens on Fridays, you'll see sell-offs, we'll see volatility. But I think that money right now, unless we see this Fed hike rates to 8, 9, something significant as we saw in this last hike cycle, which also didn't really impact the markets too badly as it started to go, because in tandem inflation was coming down because roots were being sorted out and production was occurring. I don't think it really. I think we continue to see the upside, honestly, in the markets, with the exception of these volatile periods. And we continue, and we're going to have this conversation, David, for ages going forward as to whether or not we have higher debt, a higher deficit, and what's going to happen, and if the markets are going to care or not care. And I think we're in a period right now where, unless it's significant, not a quarter, not 1 quarter, not a few months, we have significant, prolonged, really super high squeezy inflation, that they're really going to be impacted for too long on any sort of negative way.
I'd like to play for you a short clip from the March FOMC meeting. A reporter asked Powell a very good question that ties into the themes we've discussed today and permanent distortions your work. Take a listen.
The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks. And, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact. Yeah,
that's a fact. I wonder if he's going to forward project this and bake economic and central bank policy into this fact. What do you think?
It's interesting because the book that I'm actually writing right now, Commodity Wars, is specifically about the weaponization of the supply chain. And from an international perspective. So, shocks don't COVID kind of occurred. Yeah, we could debate how that actually started, but COVID kind of occurred, yes, as a major sort of shock. We weren't necessarily expecting an entire shutdown of economies throughout the world and production and mines and the whole thing. That was, but what's happening in Iran, or what happened with Ukraine and Russia, the fact that when you have a geopolitical issue or military warfare issue of country against country, and any of those countries control any part of a major supply chain, we're going to see spikes. So I do think we are in, and this it kind of relates to the concept of a commodity super cycle on the pricing side, but on the standpoint of where we're at right now, in the period that we're entering right now, Powell tried to say at the end of his talk, he kind of said 2 things, as he usually does, but this idea that we've seen more in the last 5 years than beforehand. Yes, the fact is we are heading into more structural deficits of supply. We are heading into periods where there is less stuff coming out of the ground to process than there has been before. And if you couple that with more geopolitical power plays, some of which is why we have gold as a top reserve right now of central banks, to be able to diversify against fiat currency, against the dollar, against U.S. monetary policy. We are going to see tungsten going up by 900%. We are going to see supply shocks, whether they're more isolated and they're in commodities that nobody's heard of, like tungsten, or most people haven't, or if they're in major ones that everybody knows about, like oil. Yeah, we are going to see more weaponization of parts of the supply chain, whether it's export controls, choke points, keeping mines inside of countries, using it as a bargaining chip with other strategic partners in the world. Yes, we are in a period right now where we will see more and more of that in select parts of the market sometimes, and in multiple parts at the same time other times perhaps. But we are net deficient of supply of what we need to continue moving forward.
If you had to rewrite, final question, if you had to rewrite or even add a chapter to permanent distortions, given the shocks that we've seen since you've written the book, anything you would change or add?
Well, the whole next book. So
Okay.
I was planning. Well, no, it's an interesting question. No, because permanent distortion to me was the third of a trilogy, right? I
Sure.
started with the history of the Fed, central banks, bankers, and presidents, and all presidents, bankers. I went to collusion. It was a global exploration of what was going on in central banks and monetary policy globally. And then permanent distortion was like, okay, this is where we've gotten to. We've gotten to this incredible permanent distortion between basically money creation and what it does to societies and the disruption it causes to people, to production, to countries around the world. And I would have stopped there because, when you say permanent, you're kind of like, okay, that's the end of my trilogy. But we have this period now where commodity warfare is basically, it's not even just more than it was in the last 5 years. We're basically looking at where it was when it repositioned the world from basically the Civil War through World War II. I mean, there was a whole period of movement in terms of who's producing what and where and how countries are evolving and powers are determining where steel goes, where aluminum goes, the hot magnets that were created in the late 1800s, early 1900s. We're in that kind of a period. Except that there's more at stake, there's more activity in the world, there's more weaponry in the world, there's more players of countries and alliances that are being created on the back of commodities, not money. And so I would have said that would be the other chapter. And I talked about hard assets, real assets as being the beneficiaries in the end of permanent distortion. I probably did it in the intro as well. And now we're exploring that whole arc, and that's, so it's not a chapter anymore. It's a rather lengthy book right now, David. I'm on chapter 7 of 10 that I am working on. So
when can we expect this lengthy book to be ready?
It is due the end of this year to my publisher, and then the gods of publishing, or goddesses that figure out how things get through their chain, and when they hit the market, we'll determine when it actually comes out. But I will definitely keep you posted.
Hopefully, there's no supply chain disruption in the publishing business, and we can expect your book to hit markets as soon as it's ready. Thank you very much, Nomi. I'll follow you where in the meantime?
So come to printsites.substack.com. It's where all of my research is. It's where our premium portfolio services are, and investment suggestions and analysis.
Thank you very much. Please follow Nomi in the links down below, and we'll speak again soon.
Thank you so much.
Thank you for watching. Don't forget to like and subscribe.